So now in part 5 of lecture 1, let's talk about why we want to focus on these three questions. Where will interest rates be in 5 years? Can the US economy grow at 3% a year for the next 10 years? And is the stock market overvalued? So let's start off with this question, where will interest rates be in 5 years? This is obviously a key question for investors and for monetary policy. If we look at the data, what we're going to see is that interest rates are low on a historical basis, and actually in most advanced countries. In fact, they're the lowest they have ever been in roughly 100 years of data. So the real problem we face in trying to answer this question of where will interest rates be in 5 years is, are we going to see interest rates go back to the average levels that we've seen over the last, say, 50 years? Or are we in a new normal where we're going to be seeing low interest rates like the ones we have now, close to zero, for decades? So let's take a quick look at some of the data. This is a picture of long-term interest rates on government bonds in the United States from the middle of the 1920s until now. So I've gone to the St. Louis Fed's website, Fred, and basically put together two series. One is an old series that they had that just looked at the interest rates on long-term government bonds without specifying exactly what the maturity of those bonds is. And the blue line is a graph of the 10-year, what they call constant maturity interest rate on US government bonds. So you see where the series overlap, they're quite similar, the same general pattern. So we're going to use the orange series going backwards here where we don't have data on the blue series. And we're going to use the blue series data here where we don't have data on the orange series. So what we have on the y-axis is the yield to maturity, or what would typically be called the interest rate on these long-term bonds, say 2, 4, 6, 8, 10, 12, 14. And we see a striking pattern. These interest rates fell in what we call the Great Depression to a very low level during World War II and a bit beyond of around 2%. And then they rose to be quite high in right around 1980, 81. Here we see 10-year interest rates going up to 15%. And then since that time period, in the early 1980s, interest rates have fallen quite substantially down to new low levels that are under 2%. And if we update this chart to include interest rates from the most recent days, the 10-year interest rate is down close to zero. Now, this pattern of rising and falling long-term interest rates has been seen in many countries. This is a graph of 10-year interest rates around the world starting from about 1960, and we have data to the present, and we have data for the United States in blue, Germany in orange, the United Kingdom in green, and Japan comes in more recently in red. And what we see, it's a little bit hard to see, here's the US increase and fall. We see that the UK had a bit of an earlier increase and then a fall. Germany didn't quite have the same increase, but the rates are reasonably high. But once you get into about, say, 1995, the interest rates for the United States, Germany, and the United Kingdom are moving quite closely together. And Japan led the way in heading towards low interest rates. But now, at least Germany, it seems to be catching up with Japan with 10-year interest rates down near zero. And as I mentioned, in the most recent weeks since this graph was created, the United States interest rates for 10 years has also fallen to zero. So this is really quite striking that even though these interest rates are all in different currencies, the Japanese interest rate is in Japanese yen, the German one is in euros, the UK one is in British pounds, and the United States one is in US dollars, it's quite striking how much these interest rates tend to move together. I will say as an aside, something that's been coming up recently is that the interest rates and exchange rates are not moving in ways that make sense. If you go actually and buy a Japanese bond, say over here, I'll go back to it, when it had a very low interest rate in this time period, you could ask yourself, if I'm an American investor and if I convert my US dollars into Japanese yen, I buy Japanese bonds and convert the dollars back, do I get a better rate of return on that investment than I get from just buying a 10-year US government bond? And the answer is actually quite surprising. The answer is you've been getting a higher rate of return on the Japanese bond, even if you use what's called a full maturity US dollar hedge to take care of the risk that the yen will change relative to the dollar over the time period that you hold the bond. So economic theory says if you actually hedge the exchange rate risk, the rate of return you get on those two investments should be exactly the same. This is a graph of the difference between the rate of return you get on the Japanese bond, converting your dollars into yen, and in advance using what are called currency forwards to fully hedge the exchange rate risk when you need to convert the money back. Instead of this, and you compare that to the rate of return on US dollar bonds, instead of this interest rate differential being zero, it's actually been 50 to 100 basis points, or half a percentage point to 1 percentage point, and it's down now to about half a percentage point. So this is like a risk-free way to make money by taking your dollars and investing them in Japanese bonds. This is typically regarded as a sign that there's frictions in the financial markets that are preventing investors from arbitraging away these differential returns in bonds of different currencies. So we can ask the question of where do we think interest rates will go next? So we've seen pictures where interest rates have been on the decline worldwide since the mid-1980s. And everyone is asking themselves, are they going to just keep going down as they have been for decades? Or at some point, are they going to start going back up? Well, what we see is that forecasters, particularly the Federal Reserve, have been wrong in their forecasts many times in a row for quite a long time. So in this graph, what I show is what are the forecasts that participants in the Federal Open Market Committee, that's the committee that sets interest rates at the Federal Reserve, they make a forecast of where their policy rate, the federal funds rate, is going to be in the long term. And on the x-axis, we have the dates where they're making the forecast. And on the y-axis, we have what their forecast is. And what we see is since 2012 and going into 2013, year after year, the Fed has been reducing their forecasts as long-term interest rates fall further and further. So you notice that at the end of this graph, which is not too long ago, the Federal Reserve was still forecasting that the short-term interest rate, the federal funds rate, was going to be, 2.5%. And what is that interest rate now? In response to this coronavirus emergency, they just cut it to zero. And long-term interest rates are cutting to zero. I will be interested to see next time the Fed makes a forecast where they think this thing is going to be in the long run. I suspect it's going to come in at an even lower number. So to give you another perspective on this contradiction, in some sense, these repeated mistakes of the Federal Reserve and actual other interest rate forecasters, here's a picture that's from a JP Morgan asset management document that I thought was kind of interesting. So it goes back to 1999, and it shows you a picture of what's been going on with the federal funds rate over the time period from 1999, not quite to the present because they're missing what just happened, but through December of 2019. So we see the federal funds rate being 5-6%, falling as they fought a recession in the early 2000s, rising again up to 5%, falling in the crisis connected to 2008, down to zero. The Federal Reserve held the policy rate at zero for a long time. And then starting in 2015, they had a gradual process of raising the rate in little steps when they got to, 2.25%. And they made some cuts before this crisis. But what this graph wants to say is we have here in the blue diamonds, these are the forecasts of where participants in the Federal Open Market Committee thought the interest rate was going to go, which is up towards 2.5. And the black diamonds reflect a forecast that is taken from the term structure of interest rates. It's called a market expectations because it's taken from market prices. And at the same time that the Federal Reserve is predicting interest rates going to go up, the market is predicting interest rates are going to go down. So there's a pretty big disconnect between what the Federal Reserve and other professional forecasters are saying and what seems to be going on in terms of market expectations of where interest rates will be. So the distinction, I think, really lies in the fact that the Federal Reserve is building in a model in their heads, in which interest rates are stationary, which means that eventually they should go back to some long-run average level that a lot of people think is about 5%. I suspect what's going on is that the market does not think interest rates are stationary. They are not thinking we're going to be returning to a long-run level consistent with, say, what's happened over the last 50 or 100 years. I think instead, the market might be thinking we're in a new normal with perpetually lower interest rates, or at least interest rates that are a lot lower over the next several decades. And so the reason we're talking about this first question of where will interest rates be is not just because we're interested in interest rates, but also because we want to understand and be able to talk about situations where market signals seem to be giving us information that contradicts what we see coming out of professional forecasters. So that's the end of this part of Lecture 1. And I'll take up our second question about how fast can the U.S. economy grow in the next part of Lecture 1.